Hey everybody, I just wanted to walk you through something I found interesting. This is in regards to the conversations around, inflation and money supply and how that relates to actually getting returns in the stock market. So one of the things I've seen is charts that look like this. So this is a site called TradingView um, that I just started using recently. It seems really cool, but and you can use it to do different comparisons. So this is an example of like M2SL. That's the money supply as measured by the St. Louis Federal Reserve, which has a great site. And you can kind of see this is going back to 2000. It's grown a lot, and this spike right here represents the massive amount of um, money that's been added to the system since coronavirus. And this is the NASDAQ composite going back to that time. So the date range here, just so you see it, is from March of 2000, which is basically the dot-com peak, through the beginning of October. And you can see the NASDAQ has performed quite well, even though this was a very big peak. It took a long time to come back. It took about till 14. So you had 14 years in the NASDAQ where you were underwater. Oh, incidentally, this doesn't include dividends reinvested or anything. This is just straight the price. So imagine you invest in an index fund and you take the dividends out and buy, avocado toast or whatever. So then for the last 7 years or so, 6 years, you did pretty well, especially since March of 2000. Market's done pretty well, or 2020, sorry. But when we correct for the increase in money supply, it's underwater. And so the narrative there is the money supply will show up in as inflation, and that's people are speculating why. That's why you can sell your used car for more than you bought it for, and nobody can afford a house anymore, and there's a narrative of inflation. Now I don't know what's going to happen with inflation. You saw that Jack Dorsey said hyperinflation is coming and financial markets are going to be destroyed, and the system's coming apart, and the Federal Reserve has no choice because the United States and other countries run on huge deficits, and they have no way out of this. I don't know if that's true or not. Maybe it's true, maybe it's not. But so behind this idea is when you look at your returns in the NASDAQ, say this return of 230% since March of 2000, if you divide it by the money supply, then you're still underwater by 22%. Now, I don't think that is a useful way to look at it, because how much things have increased in price in my day-to-day life. In other words, the hamburgers that I buy, the mortgage that I pay, the car that I drive and pay for, and the health care that I have to buy is not directly correlated to the amount of money in the system. In this case, I don't know exactly, but I think that the money supply increase has outpaced the cost of things increasing over the same period of time. Even if you take stuff like education and healthcare, that's gone up a lot, versus televisions, which are probably cheaper in the same basis. But anyway, the point is you can create a chart like this that says, oh, look, but in reality, your stock returns have underperformed because you have to divide it by the M2 money supply. Now, the problem with that analysis is it doesn't tell you if that's true because the assets that you bought in March 2000 were way overpriced, or because the increase in money supply has eradicated the returns. And so to show you how big of an impact this has, if we just scroll this a little bit over to 2002, when now you're buying equities at the bottom, you can see that even divided by the money supply, the returns are actually quite good, 183%. So even with all that printing, if you invested in 2002, your equity returns outperform the money supply. And that's true most of the way. It never goes negative again, right? Even if you go like to 2016, you were, you're young, you just started investing. You put all your money in an index fund, and for the NASDAQ in 2016, and the government printed like a drunken sailor, and that's driving you crazy. well, you're still up. Even if you believe the narrative that the money supply is directly connected to inflation. The same is true when you go back. So if you just go a little bit back before the .com peak, like let's say you bought not quite at the peak, you still are fine. And in fact, the further you go back, the more true this becomes. Now, of course, you can't. The NASDAQ doesn't go back forever, so you can't do this forever. But you can see, stock market returns are generally pretty good. Now, let's talk a little bit about what's cool about this tool. Is it has cryptos in it, which I think is great. So you can go look at the Bitcoin crypto number. Okay, so this is the other thing I see a lot. No, I haven't seen this chart exactly, but it really puts things in perspective. So if we look at, this is Bitcoin price, we go back to say, around 2017. Well, you could have been down here with your QQQ index fund, and even with the increase in money supply, maybe it reduced your return from 180% to 100%, but it's nothing compared to what Bitcoin has returned, 6,271% in that same period of time. And a lot of that is coming, in March. So if we go back here, like 2016, 2017, Bitcoin is doing okay already here, right? And there was this crash in 2018 where it dropped a bunch, and so maybe if you got in on this peak over here, you were feeling pretty bad because you were down 50%. But all you had to do was wait a little bit, right? And you can see, what is this? So you're already back here in 2019. This is before COVID, and then here we go forward. So things are okay. And then COVID hits, and when COVID hits, it takes a little while for people to sort of react. And then right around June, July, we're doing pretty well. September, October, November, it really takes off like a rocket. And you guys all remember this if you were tracing it. And then it came down again for a while, and now of course it's skyrocketing back up again. So you see this very, very steep curve, and there's nothing like it in history. This is the narrative, right? Like even I'll get rid of the Bitcoin here for a second. Even the .com boom, if we go back and look at this chart, okay, where we let's just look at like the 90s or so. Okay, so we see this kind of an exponential rise, and very similar kinds of narratives. This is when I started investing. Very similar narratives. This is the new economy. All these old investors don't get it. They don't understand. Everything's changed. The internet's going to change everything, which it did. And then of course it came right back down again. And and I think what this 20 years here between the NASDAQ, peaking, dropping, and then coming back, this void of about 15 years, I'd say, is the actual power of and value of the internet catching up with its promise. And so, this is what a bubble looks like, and they're in everything. It doesn't matter. It has nothing to do with the asset itself. Like the NASDAQ can be a bubble, gold can be a bubble, housing can be a bubble, tulips can be a bubble, land can be a bubble, anything can be a bubble. It just requires the right narrative for people to believe in it. So let's go back to Bitcoin here because I want to say something else here. So you can kind of see, when we really pull back, it really is special. And this is sort of what makes a very compelling narrative for Bitcoin. Like, how on earth can something be so dominant over anything else in the past and not be massively transformative to the world? And so maybe that's true. But the problem is that it doesn't, to me, have anything to do with the money supply narrative. Doesn't hold up because the amount of money that's been printed relative to the rise in Bitcoin is there's orders of magnitude in between. Now you could say that that's because Bitcoin investors, that Bitcoin's pulling that inflation that's coming forward because there's this downward spiral that we can't pull out of. We have to keep printing money to pay off the debt. We have to keep interest rates low, but to do that we have to print more money, and so we can't get out of it. That may be true. I don't know if that narrative's true, but I don't know how that's going to necessarily um, drive the adoption of Bitcoin or anything like that. This to me looks much more like a classic speculative bubble that's just grown very, very quickly. And I think, I would not be surprised if it grew much more, because the technologies that we have nowadays, the connectiveness, the globalness, the speed, um, it just makes these things much more accessible to people. Like anybody can start buying Bitcoin within seconds and trading it and speculating on it and so on. And the narratives around it are also much, much louder. So, um, you know, and this isn't a dig on Bitcoin necessarily. Like there's people out there that say like, oh, Bitcoin is a Ponzi scheme, it's going to zero and all this kind of stuff. I don't know if that's true or not. The NASDAQ wasn't a Ponzi scheme. Housing isn't a Ponzi scheme. Even tulips aren't a Ponzi scheme. Those are real things that have value. It's just the mania drove the valuations to astonishingly high levels that then had to be corrected when things came back down to normal. And so, to me, this just looks much more like a bubble, driven by a mania. And and actually, the narrative that I see playing out now is that well, look, all these financial institutions are getting into Bitcoin. That's totally true. What I would encourage you to do is look at what that means. What does it mean that a financial institution is getting into Bitcoin? Does it mean they're buying Bitcoin? Does it mean they're building applications that allow you to create, replace your monetary activities with Bitcoin activities? So are these financial institutions worried about the safety of the US dollar, and therefore they're starting to offer you mortgages in Bitcoin and auto loans in Bitcoin and travel points and credit cards in Bitcoin? Or are they creating services that allow them to collect fees, usually in fiat money, on your trading activities? So, are they creating an ETF because they were going to take 1% of your transaction fees? Are they creating applications where you can trade, various cryptos with your friends and people online so that they can take transaction fees, right? Are they offering it because their clients are saying, hey, look, I want to get in on this Bitcoin thing, and you don't offer it, so they feel the pressure to offer it? So you have to really look carefully, what does it mean when a financial institution gets into Bitcoin? Because all the financial institutions were also into the dot-coms, and all the financial institutions were also into housing, because that's where the demand was. Like everybody was getting into, securitization of loans in the mid 2000s because there was a demand for it. And so financial institutions will offer the public whatever the public wants to buy, and they're happy to charge fees and collect them. So you can't. I would be careful not to use the interest of financial institutions in something as an indicator of its safety and legitimacy. Could be. So what I'm looking for with Bitcoin, what I'm really interested in is like when I see things that I consider traditional financial institutions to offer suddenly being offered and denominated in cryptocurrencies. So if I could buy a life insurance policy that paid out in Bitcoin, not dollar adjusted, not I convert the dollars at the time to Bitcoin and it pays it out. I mean it fixed in the future. Or if I could buy a house in a 30-year mortgage at whatever the interest rate is, denominated in Bitcoin, something like that. Now, of course, I understand there's all sorts of regulatory reasons why that might not be possible, but that to me would be much more of an indication that we're seeing people have less confidence in fiat currencies and see them being replaced with cryptocurrencies. Now, I do believe some of that seems to be happening in places where the population has lost faith in their currency, especially in countries where the government has collapsed or the financial elements of the country have completely collapsed. People cite Venezuela, of course, they cite hyperinflation in Germany, but these are all cases. You should just go back and look at the history. These are usually cases where there's some pre-existing geopolitical or economic disaster that causes the the currency to become worthless very rapidly. In the case of something like hyperinflation in Germany, it's because their debt is denominated not in their own currency, right? So they have to pay it back. In order to do that, they have to buy gold in the market. So they have to keep printing the money to buy the gold to pay back the reparations, and that was, unmanageable, and it led to hyperinflation that is unimaginable, nothing like what we're seeing today. Cost of things, I think, in a year went from 20 marks to like 2 million or 200 million or something. Like, it was really crazy. Um, in Venezuela, I think it's largely oil related. If your entire economy is based on a commodity like oil, and the price of oil drops, significantly in a short period of time, it can crush your finances. And if your loans are denominated in a foreign currency, then you're in trouble. And so that could happen, of course, in the United States, but I don't think what we're seeing is any indication of something. I don't see anything that indicates a huge economic shock. Now, and in the case, let's go back to Germany for a second. In Germany, what did the government do? Well, they just discontinued the old mark and they implemented the new mark. And even though people had no faith in the old mark or in the government's financial responsibility, they did adopt the new mark, because what choice do they have? So maybe you have a situation where there's some massive cataclysmic event, or the US defaults, or the entire global economic system collapses, and rather than people having faith in the old currencies, they put their faith in decentralized cryptocurrency of some kind. Um, that just feels went many steps forward to me. Um, and to have so much confidence in it, that I would put all my investable assets, or even a small amount of them, in there, it doesn't pass for me rationally. There are people it does pass rationally. That's fine. That's, the market is the market. But to me, thinking about simplicity and explaining data and trying to look at what's going on, to me it makes a lot more sense that what's driving this massive rise here, that's unprecedented, is, mania. When I look on Twitter and I search under Bitcoin, just go on Twitter, look for Bitcoin, or whatever you want to do. It's just spams of people who are trying to get rich, who are trying to say, oh, I'm going to buy it, it's going to double, and I'm going to be rich. And they're rich in dollar terms, And there are people who, I would call them sort of these Bitcoin theoretical purists. They've been around for a long time, and they're not moved by this mania. If the Bitcoin price drops in half, they don't care, because they see this long-term adoption. And I think that's a much more defensible position, and maybe that's true. But we've seen that also in other sort of inflation protection investments, like gold bugs have been around forever, and gold people tend to be sort of like, well, we got off the gold standard and that was the end of real money, and eventually this whole house of cards is going to come down, and then people are going to go back to gold. And as I just showed you a few minutes ago, that's fine, but if you invested in gold since the inflation in the 70s versus just a bunch of productive equities, well, you're still waiting for that collapse to happen. Um, and in the meantime, your returns have been very poor, even relative to the money supply. So whenever you see these kinds of things, I encourage you, crack open software like this, take a look, do your own research, do your own thinking, draw your own conclusions. Watch out for emotional appeal arguments from that perspective. So hopefully this was interesting.